The major US stock indices recovered yesterday, led by the Russell 2000 and the Nasdaq 100. Both rallied close to 1.2% to 1.1% due to the walkback of the US White House administration new global reciprocal tariffs from 15% to 10%, and also added by a better than expected Conference Board consumer confidence data for January. In the FX market, a bit of whipsaw due to this strength in the dollar yen, where the yen yesterday weakened to a very strangely old report that stated that Prime Minister Takagi displeasure on Bank of Japan current gradual interest rate hike stance, as it was reported due to last week meeting between the BOJ governor and the Prime Minister, which is a very strange news flow that causes the dollar yen to actually spike up to 155 handle. But interestingly, in today's spike up to 156 handle, but very interestingly, the dollar yen doesn't seem to able to find much traction above the 50-day moving average as we are speaking right now. Very good morning to all, and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be the Wednesday, the 25th of February 2026. So as usual, before we kickstart the gist of the Daily Dose, let's have a quick look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So before we jump straight into today's full suite of the daily dose, which I will cover all the intraday technical outlook on all the broad-based cross asset classes that we do on a frequent basis. Let's have a recap what has taken shape yesterday in terms of news flow, relevant data release, and as well as their intraday impact on the broad-based cross asset classes. So yesterday's big news flow was pertaining to tariffs over here. So we know that there has been this tariff chaos since the start of this week, coupled with this AI disruption trade play that causes this across the board risk off scenario in general in the US stock market. So yesterday was a relief to the US stock market, where Trump's White House administration actually walked back on his threatened 15% tariff. Still remember that why this 15% tariffs came about, because of last Friday, US Supreme Court struck down Trump global reciprocal tariff, which was the baseline of 10%, deeming it as illegal. So Trump tried to circumvent the Supreme Court verdict by introducing the global tariff rate to 15%. So that was tweeted on the previous Saturday over the weekend. But officially, once this come into law, I mean after the executive order is being signed, instead of 15%, Trump's White House administration announced an official rate of 10% global tariff, which went into effect on Tuesday over here. So this is to actually replace the US Supreme Court decision that deemed the previous 10% base tariffs as illegal. So Trump introduced this new 10% global tariff under Section 122, which only lasted for 150 days for now. All right, so but he himself threatened to subsequently rise the number to 15% again, but he did not officially issue a directive to increase the rate as of Tuesday, 12:01 a.m. over here. All right, so then overall that was kind of a relief to the US stock market over here, where we saw the all the benchmark stock indices rallied over here in the green, but bear in mind that they are still in a range scenario, and the Nasdaq 100, the SPX 100 all rallied to the range resistance, and even the Dow Jones Industrial Average as well. Later I'll share with you guys what are the key levels to look at. So the top performer, like I mentioned, will be the Nasdaq 100 up 1.10% or 1.09%, followed by the Russell 2000 up 1.2% over here. So even before this ongoing trade chaos fiasco got started, the rest of the world stock market, especially in the Asia Pacific, continues to outperform the major US stock indices since the start of this year. And with this tariff chaos getting subsided so far for now, we continue to see this outperformance in the major Asia benchmark stock indices. So the Nikkei 225 rallied up by 1.44%. So the cash market today hit a fresh all-time high, 58,145. And the Nikkei 225 futures contract, which our Japan 225 track, CFD index that track this Nikkei 225 futures contract, up 0.36% so far, taking into account of yesterday's US price action as well. So that is at 58,185. All right, over here. So over here, the Hang Seng indices recovered from yesterday's losses, up 0.7% over here. The China A50 index continues to bask in a bullish limelight as it continues to trade for its second consecutive positive day so far after its CNY break, where the China stock A share market reopened for business on this Tuesday. So the wider CSI 300 index that comprises the big cap 300 stocks that are listed both on the Shenzhen and Shanghai Stock Exchange, up by 0.87%. The narrower China A50 index up by 0.89%. Both of them are trading near the trading at intraday highs so far. And over to the rest of the markets, the ASX 200 up by 1.11% over here. The Kospi 200 continues to remain red hot, surging to a fresh all-time high, up by 2.3%. And our Singapore Straits Times Index almost unchanged right now at negative 0.05% over here. So net overall, what we could see over here is that the US stock indices continues to range over here within those set boundaries, which are highlighted yesterday. The rest of the world markets, especially the Asia Pacific stock market, continues to be in a bullish medium-term uptrending phase and continues to outperform the major US stock indices based on the technical analysis perspective. And over in the FX market over here, based on this 5-day rolling performance of the US dollar against other major currency, as we're speaking right now, 25th of February, the dollar continues to weaken, and the dollar is weakening the most against the Aussie dollar, where the dollar is down by negative 0.7% against the Australian dollar. And even yesterday's spike up of the dollar yen, so the dollar yen also now starts to trade below the 156 level. So let me touch you what causes the dollar yen to spike up yesterday, clearing above the 156 level, was due to this very strange news flow that was reported by the local Japanese press between the meetup between Prime Minister Takachi and Bank of Japan Governor Uda. So that meetup was not taken shape yesterday. It was taken up last week over here. So the report the local report just stated up more details about last week meetup between Takachi and as PM Takachi and the Bank of Japan Governor Uda over here, where she voiced apprehension, that means a bit of displeasure over more rate hikes in a meeting between her and the Bank of Japan Uda. So we know that BOJ itself has more or less been resolved in not going back to quantitative easing again. That means they are more in favor of keeping interest rate as it were right now, and even potentially introducing more interest rate hikes on a gradual basis as Japan continues to get out of deflationary, and given the fact that the current expansionary fiscal policy that the current Japanese administration is embarking on, and given the fact that Japan Prime Minister Takachi coalition party won a super majority in the lower house, so that give her more leeway to push for more aggressive fiscal policy. So with more aggressive fiscal policy, inflation trend will tends to go up rather than come down. So that is actually goes in line with Bank of Japan gradual interest rate hike to actually counter this ongoing economic growth situation in Japan. But however, we know that policymakers wants to have the best of both worlds. That's actually explained to us. Potentially, there could be some form of toggle hurdle between the administration goes and the Bank of Japan goes. So that actually causes the dollar yen to spike up. So later I'll share with the chart the dollar yen. Very interestingly, the spike up stopped exactly at the 50-day moving average over here. And the reason why the Australia dollar is so strong against the USD, that means the USD is so weak against the Aussie dollar as we're speaking right now. On a 5-day rolling basis, they are down by negative 0.68. And if you look at the 1-day rolling performance basis, down by negative 0.5. That means the dollar is down against the Aussie by negative 0.5. Very clearly, startlingly, underperformance of the dollar against the Australia dollar is due to a continuation of pricing of the Australia Central Bank to remains hawkish throughout the first half of this year. Why? Because Australia, we call it the core inflation rate, all right? The RBA trim mean core inflation, this trim, they call it trim mean, which is core CPI, year on year for January came in hotter than expected. So it came in at 3.4%, way above, slightly above what market is expecting at 3.3%, and also previous December print of 3.3% as well. So at 3.4%, if you look at the trend of the core CPI trend in Australia, it's actually inching upwards, all right, and it's the highest level since 2024, so something like that. So you see at 3.4%, it's the highest level since September 2024 at 3.6. So if you look at since the low of 2.9% printed in March last year, it has been in a gradual upward trending. And with this gradual upward trending stubbornly remaining above RBA's band of desired long-term interest rate, which is 2% to 3%, that will potentially keep the hawkish vibes alive in RBA. And bear in mind that RBA is the first central bank this year to potentially hike interest rate, getting out of their interest rate cut cycle that was last year. So with this rather fundamental, hotter than expected inflation trend in Australia, that could potentially support the hawks in RBA, which in turn potentially see a widening of Australia's short-term interest rate premium over the US, which eventually supports further strengthening of the Aussie dollar that we have been in our short-term technical view holding above the 70-20 key short-term pivotal support, which we highlighted a couple of days ago. So later I'll touch on more about the charts as well over here. All right, so that's pretty much sum up today's first segment of the daily dose over here. So let me now move on to the second segment, all right, which I will cover more on. Let me make sure that the screen is good over here. All right, so let me now touch on the FX market first. All right, so let me expand my screen right over here. So let me touch on the FX market, which is the euro dollar. So the euro dollar continues to trade in a very boring sideways configuration. So what we could see is that the price action on the euro dollar, okay, let me expand it, starts to form a higher low. Okay, let me put it this way. After a retest and a challenge on the 50-day moving average on last Friday, and as well as so far this week over here. So the RSI also continues to shape a series of higher low as well. So indicating that support still holds for now, but it still can't break above the 20-day moving average, which is very close to the prior key minor swing high of 18th of February at 118.60. So unless price action able to break above 118.60, then potentially we're able to see much more intraday pronounced bullish momentum coming back into the euro dollar. So for now, we're still having a mild bullish bias on the euro dollar, given that 118.60 couldn't break out. So pivotal support still remains the same at 117.40, 117.28 for now, which was last Friday swing low area. Only a clearance above 118.60, then potentially the bulls may gain more traction to seek out the next intermediate resistance at 119.27. The next step, followed by 119.93 next. If that takes shape, I will tighten my pivotal support to 117.76 next. However, if price action U-turn from here and stage a bearish breakdown and hourly close below 117.28, the mild bullish bias view will be invalidated to see the continuation of this corrective decline sequence further extending exposing the next near-term support level at 116.73, 116.32, which is the minor congestion area of 19th of Jan and 20th of Jan, and also in between the area that is coming of the 200-day moving average. Next will be the sterling pound, the pound against the dollar. So the pound against the dollar also continues to trade below the 50-day moving average, but can't break below the 200-day moving average, which is our key pivotal short-term support that we highlighted earlier on Monday. So what we could see over here is that very encouraging, we start to see a series of higher low that starts to form on the sterling dollar over here. So with that, we'll still maintain that mild bullish bias unless it's able to clear above the 50-day moving average, which is confluencing with this intermediate range resistance that has been in place since Monday, 23rd of February, which let me put in writing for you guys. So that will be at 135.33. All right, 1.3533. Right, so a clearance above 1.3533 may expose the next intermediate resistance level, at least for the bulls to gain much more traction for this mild minor bullish breakout from this range resistance that has been formed on the minor time scale since this Monday to expose the next intermediate resistance at 1.3588, which confluence with this 20-day moving average, I think, as a resistance level as well. However, a bearish breakdown below the 200-day moving average, which confluence with our short-term pivotal resistance zone that maintain the same at 1.3455/1.3434, then the corrective decline sequence may extend further to the downside, further exposing the next two intermediate support level at 1.34 figure level, 1.3348 next. So that's for the sterling dollar. Next will be the top performing currency against the USD, which is the Aussie dollar, where previously we have formed as our chart of the day, and we also continues to maintain that bullish stance since holding above this 20-day moving average, where he starts to form now a minor double bottom formation, right, with the neckline resistance at 71.11 over here. Okay, let me put it in writing. Okay, 0.71. Okay. Maintain that bullish bias. RSI continues to remain in a bullish dynamic as it continues to shape a higher low above the 50 level mark. Hasn't hit the overbought region yet. So using 70-35, 70-20 as my short-term pivotal support level for now, given that it hasn't broken above 71.11. A clearance above 71.11 potentially retest 71.40, followed by 71.75, then thereafter 72.10 in the days ahead, as this bullish dynamic continues to play out in the Aussie dollar. If you're able to see a clearance above 71.11 thereafter during the European session and the hourly close above it, then I would tighten the short-term pivotal support level to today's Asia session low. Okay, let me put it over here. Okay, that will be at 70.57. All right, 70.57. However, a bearish breakdown below 70.20 and hourly close below it, that means that would invalidate the double bottom minor bullish formation and see another round of corrective decline sequence unfolding again, exposing 69.80 in first step, followed by 69.07, 68.90 next, which is the key bullish reversal low that has been formed on the 6th of February, and as well as the previous gap up support level that was formed on the 26th of January. Right, so that's for the Aussie dollar. Next up will be the rather choppy dollar yen. So like I mentioned, the dollar yen spike up yesterday. So this spike up paused at the 50-day moving average, which is at 56.36. So given such mixed element that we are seeing now in the FX market, I would have a neutrality stance for now for today on the dollar yen. So neutral between 156.36 and the lower limit, which yesterday's short-term pivotal resistance zone, now turns into a critical pullback support level. That also confluence with the 20-day moving average at 154.95 154.65. Okay, so neutral between 156.36 and 154.95, 154/65. So that's for the dollar yen for now. All right, so let's sum up the intraday technical outlook on all the 4 major US dollar pair. Let us now take a look at the major stock indices, starting with the Hong Kong 33 that is representing the Hang Seng Index. So the Hong Kong 33 managed to bounce up at the 50-day moving average. So that is also our pivotal support level as well, but still can't clear above this former minor swing high of 12 of February that kickstarted this rather choppy range configuration. So one thing positive that it managed to form a higher low as well at the 50-day moving average after the retest of it on 13th of February, pardon me, and on yesterday, 24th of February over here. So with that, still maintaining that bullish bias over here, amount one, given that he can't clear above 27,228 for now, and even still remains below the major resistance of 27,500. So maintain a mild bullish bias using pivotal support level, which is a bit of excess of yesterday's intraday low at 455, 26,615, 26,455 over here. First resistance level to watch 27,228, followed by the major resistance of 27,500. However, a bearish breakdown below 26,455 will negate the bullish bias view to see it retest on this range support level, a minor range support level that has been in play since the low of 6th of February at 26,285. Only a breakdown below 26,285 may trigger another round of minor corrective decline sequence, exposing the next two support level to watch: 25,970, 25,820, followed by 25,530, which confluence with the 200-day moving average, right? And also the minor swing low of 29th of December and 31st of December. So just have a quick recap why 27,500 is a major resistance. That we have to go to the weekly time frame chart of the Hong Kong 33, represent the Hang Seng Index. 27,500 indeed was tested 4 times so far in the week of 29th of September last year, the week of 12th of January this year, the week of 26th of January this year, and most recently the week of 9th of February this year. And also this long-term circular descending trend line that has been in play since the current all-time high that was printed way back in 29 January 2018 before the COVID outbreak over here. So for sure, in order for the boost to gain traction, or for the Hong Kong 33 to actually transit into a multi-month major uptrend phase, it got to have a weekly close above 27,500. All right, so that's the importance of 27,500 on the Hong Kong 33. Next will be the Japan 225. So the Japan 225 managed to clear above our neutrality stance that we have earlier on Monday, and also cleared above the next resistance level at 57,934, and managed to shape a bullish reaction of it as we are speaking right now. So with that, I will have a tightened short-term pivot. I will have a rather tighter short-term pivotal support level and flip to a bullish bias today using Monday's minor swing high now turns into a pullback support level at 57,128. 57,128 short-term pivotal support, bullish bias for the Japan 225 that's representing the Nikkei 225. Next resistance level to watch: 58,932, followed by 59,884, which is a Fibo extension cluster level. Only a bearish breakdown below 57,128 will negate the bullish tone to see a retest at the rising 20-day moving average. 20-day moving average again at 56,096. Only a bearish breakdown below 56,096 will trigger off another round of minor corrective decline sequence, exposing the next intermediate support zone at 55,111, 54,790. Okay, next will be the Germany 30, representing the German DAX. So the Germany 30 also managed to be rather choppy, but managed to hold above the 20-day moving average at 24,847 over here. So with that, it seems to us that it will be trapped in this range where the range top will be at 18th of February, Wednesday over here. So similar high over here, came down, but managed to bounce off the 20-day moving average. So I'll be using the range support level as my short-term pivotal support level, 24,847 for today. Potentially, we may see a bounce back up to the top of the range. So unless we exit up the range top at 25,330, then the bulls were able to gain more traction at the first step to retest the current all-time high area at 13th of January, which is at 25,505. So still maintaining a mild bullish bias for today as it continues to hover within this range configuration that has been in play since 18th of February high. 18th of February high. However, a bearish breakdown below 24,847 potentially see another minor corrective decline sequence unfolding to test the next near-term support level at 24,610. Below 24,610 may see further weakness towards the key support area, which is my medium-term pivotal support area. There's also confluence with the 200-day moving average at 24,250. Right, so that's for the Germany 30. Next will be the US Wall Street 30, that's representing the Dow Jones Industrial Average. So the US Wall Street 30, it did a bearish breakdown from the range support level on Monday itself over here. And with that, the short-term intraday trajectory has now more changed to the bearish rather than the bullish side of the story. So given that we have a couple of negative reactions so far that we see in yesterday's US session at 3 a.m. Singapore time over here, which is about to close. And right now, there is another bearish reaction that is unfolding as we are speaking. So for sure, this is indeed a short-term pivotal resistance level that the bulls find it hard to surpass at this juncture. So as long as 49,265 short-term pivotal resistance holds on the Dow Jones Industrial Average, potentially there could be still some form of short-term weakness taking shape. Next support level to watch will be very close to the minor swing low that was formed on Tuesday and as well on yesterday, which is at 48,710, that confluence with the minor swing low earlier on the 6th of February. So that will be the first support level to watch for today. A breakdown below 48,710 may expose further weakness. Oops, pardon me, further weakness towards 48,388, which is close to the one-time Fibo extension of this ongoing minor corrective decline sequence within its medium-term and major uptrend phase in the US Wall Street 30. So upon hitting 48,388, that could potentially terminate this ongoing minor corrective decline sequence. Then I'll be on the lookout for bullish elements to flip my bias back to the bulls again on the US Wall Street 30. However, if price action don't float down as intended and from here it reverse upwards and have an hourly close and bullish breakout above 49,265, that would invalidate today's bearish view on the US Wall Street 30 to see it chopping back up towards the top of the range resistance again at 49,707 that has been in play since 19th of February. Above it may see a residual push up towards 49,940, which was the former key minor swing low support of 9th of February and 11th of February that got taken down on 12th of February. Price action tried to test it on 18th of February before shaping this ongoing minor corrective decline sequence. So therefore, these two resistors are very important in order for the bulls to capture and to see a new round of impulsive upmove sequence to revisit the current all-time high, which is at 47, which is this two resistance zone, 49,707, 49,940 that the bulls got to overcome. Next will be the SPX 500. So the SPX 500 continues to trade in the range. So yesterday we mentioned that these are the range level to watch. So still no change, still within a neutrality stance between 6,916, 6,932, and 6,797. So that's for the SPX 500. Similar on the Nasdaq 100 as well, managed to float up to the top of the range, which is the 20-day moving average, and now shaping a bearish reaction candlestick as we are speaking, which is at 25,084, the range resistance. So still maintaining a neutrality stance between 25,084 and 24,580 ahead of a key risk event that could shape the movement of the Nasdaq 100 and the SPX 500 after the close of the US session. Later I'll share with you what is this key risk event. All right. Next will be the commodities market over here. So maintaining a neutrality stance between the Nasdaq 100 and the SPX 500 according to those highlighted levels that I mentioned earlier. All right, so here we go on the commodities market for Gold XAU/USD. So Gold XAU/USD, yesterday we flipped to a bullish bias after the breakout of 5,170. Price action did that pullback as expected, and the pullback managed to shape a higher low right exactly at the 20-day moving average, which is our pivotal support level as well at 5,046. All right, 5,046 over here. So no change, still watching very closely 5,046 for a short-term intraday bullish stance to unfold on Gold XAU/USD. Two intermediate resistance level to watch will be a bunch of Fibo extension cluster level and Fibo retracement level, and confluence with the graphical congestion area of 13th of January and the minor swing high of 30th of graphical congestion area of 29th of January and 30th of January. 5,037, 5,320, followed by 5,448. Only a bearish breakdown below 5,046 and an hourly close below it, which is a close below the 20-day moving average. So that would invalidate the bullish bias and see another round of choppy push down back towards 4,960, followed by 4,842, which is the minor swing low of 17th of September. That means a breakdown below 5,046 would indeed suggests that the rally from 2nd of February all the way up to this Tuesday intraday high of 5,250 is a corrective rebound rather than the start of an impulsive upmove sequence. But for now, we are taking things one step at a time to have a intraday bullish bias for this minor corrective rebound sequence to extend further towards 5,037, 5,320, maximum 5,448. Using 5,046 as my short-term pivotal support level to maintain this bullish scenario. Right, next up will be the West Texas crude oil over here. So the West Texas crude oil continues to hold rather firm with our Titan short-term pivotal support at 65.59, which we highlighted as our chart of the day yesterday. Yesterday at US timing, 9 p.m. Singapore time, it indeed hit our first resistance, 66.98 before trading downwards and now shaping a higher low again. So indeed, this is a short-term pivotal support in order for the bulls to maintain its ongoing minor intraday bullish bias. Clearance above the first resistance, 66.98, may open up scope towards 67.80, which is Fibo extension level, and as well as 67.80, if we go back in time, is the minor congestion area of 30th of July and 4th of August last year. All right, above 67.80, potentially seek out 69.08, 69.26. Only a bearish breakdown below 65.59 will invalidate today's intraday bullish bias to see a corrective decline dip, exposing the next near-term support level at 63.92, which confirms very closely to the rising 20-day moving average. All right, so that sum up all the intraday technical out on a broad base across asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So so far, we're now seeing President Trump's State of the Union speech, but that doesn't really move the market much over here. So it seems to be a non-event so far. So the next data that could move the market potentially will be the GfK Germany GFA consumer confidence for March. That will be at 3 p.m. Singapore time. Market is expecting a slight improvement from negative 24.1 to negative 23.1 for the month of March. So that could potentially influence the euro crosses, and even the Germany 30 CFD index over here. And we have core inflation rate data, and as well as one ECB official speaking, Marchando at 5:10, and the core inflation rate data for Eurozone, that will be a finalized rate at 6 p.m. Singapore time. So that shouldn't be a big surprise. So usually the finalized rate is almost the same as the preliminary figure that was being reported earlier. So market is expecting at 2.2%, all right, over here. All right, so that's 6 p.m. Singapore time. And over in the US session at 10:35 p.m., we have Federal Reserve official Barkin speaking. And at 11:30 p.m. Singapore time, you have the weekly EIA crude oil stockpile change. So that could influence the short-term intraday movement of the West Texas crude oil. That will be at 11:30 p.m. Singapore time. And heading into the early Asia session on Thursday, 26th of February at 2:20 a.m. Singapore time. So that is where the US stock market is still open. Fed Musalam will be speaking at 2:20 a.m. Singapore time. And what's interesting over here is that right after the close of the US session, which is right after 5 a.m. Singapore time, there will be a key US stock that is reporting its Q4 earnings results over here. Right. So that is none other than NVIDIA, which is the AI juggernaut. Right, let me go all the way down. Yes, so NVIDIA will report its Q4 earnings this year. So this Q4 earnings last year on 25th of February, which is the close of the US session. So in exact timing, it will be right after 5 a.m. Singapore time, 24th of February, Thursday. So market is expecting a big jump. Previous EPS, earnings per share, was 0.89. Market is expecting at 1.51. All right, so that is a significant jump over here. Similar for its revenue as well, 65.41 billion versus previous revenue of 39.3 billion. So that could potentially sway the movement or sentiment of the Nasdaq 100 and the S&P 500, given that NVIDIA is the largest market cap stock in the Nasdaq 100 and the SPX 500. So something to take note of at after 5 a.m. Singapore time tomorrow, 26th of February, Thursday. All right, so with that, that sum up all the intraday stuff that I wanted to cover for today's Daily Dose. And with that, have a great day ahead, and we shall speak again tomorrow. Thank you.